So, hello and welcome for the one who joined right now to the third speech of this Strain 3. Unfortunately, Tim was not able to join us this morning, so we have a presentation from Morningstar on the new rules and a new playbook. And I let Rabuan speak. Okay, thank you very much.
Awesome, perfect. Well, thank you very much. Good morning, everyone. As we mentioned, we had to do some small adjustment to the presentation as my colleague Tim was diagnosed yesterday with COVID, so we preferred for him not to be here. So I'll be doing the presentation, and then of course we had just to do a slight change in terms of the language. So unfortunately it will be in English. So das nächste Mal hoffe ich, das auch Deutsch zu machen, aber noch nicht. Leider for today, it will be, we will have to stick to English. So just in terms of the agenda, we will be given just a short introduction about Sustainalytics, who we are as a company. And then we'll be discussing some of the current market trends that we're seeing, and with a special really focus on regulation, and more specifically on the EU Action Plan. So, who we are as a company, we've been in the responsible investment space for the last 30 years, really building up expertise on research and ratings, which is our flagship solutions. We're about 1,200 professionals. That number keeps growing every week as we onboard new colleagues. And then more than half of us are really engaged in our research activities. We are a Morningstar company since 2020, and we really represent the dedicated ESG arm of Morningstar, which allows us to be the ESG center of excellence to drive both commercial success, but as well as innovation around ESG products and solutions. So we are really the ESG hub for Morningstar. Sustainalytics is a one-stop shop for all our clients' ESG needs. We are proudly servicing our clients across the investment life cycle through our long-standing expertise, whether that's in ESG integration, compliance, reporting, screening, but as well as some of the stewardship or active ownership through our engagement services. We partner with a large variety of clients across asset managers, asset owners, pension funds, banks, but as well as corporates through our second-party opinion solutions for the green bonds emissions. We have a global presence, which really allows us to be close to our customers. We have an office here in Frankfurt and in Zurich to service our DACH region, but as well as to make sure that we help our clients address the regional challenges, especially when it comes to regulation. So in terms of the current market environment, really the perception of sustainability has changed over the last couple of years, where markets have come to realize that all investments have impacts on the environment and society, and investors increasingly want to know these impacts and how they can manage them, and what is the impact on their portfolios and investment strategies. Investors want as well to consider long-term ESG risks, such as climate change and corporate governance, when they make those long-term investment decisions. So really, in general, we can break this demand for sustainability into different macro factors. The first of them is one that, unfortunately, we started the conversation about, which is COVID-19, and we see that it really has affected societies. And a strong focus on social factors has raised and is overly weighted today in our clients' responsible investment decisions. Investor preferences are also evolving, whereby factors such as climate impact, diversity, equity, and inclusions, and transparent corporate governance are increasingly on the forefront of investors' mind. And thirdly, investors come to realize that they can also enhance investment performance through sustainable investment. So that could be a way as well to generate alpha. And then last but not least, sustainability is increasingly integrated by regulators into policy decisions and regulations, as highlighted by the EU Action Plan for Sustainable Finance. So as the market has continuously evolved for the last few years, it really has become clear that there's a definite need for a clear framework in place that enables investors to really properly understand how to invest responsibly. And then on the back of this, across Morningstar and Sustainalytics, we have launched a sustainable investment framework, which helps categorize motivations, approaches, and portfolios. And with that, that is something as well that we apply as a company across Morningstar and Sustainalytics as well in our product portfolio. So the reason why we did this, or the logic behind it, is really we felt there's an important need for both the demand and the supply sides of the market to basically speak the same language. So as such, motivations can vary. It can be driven by controlling risks, enhancing returns, not harming society or the environment, but as well as the feeling or the willingness to making a difference and really having an impact. And that could be then easily mapped to the various approaches we're seeing on the market today, whether that's through exclusions or seeking for ESG opportunities, but as well as practicing active ownership and really engaging with companies on specific themes that are of interest, and as well as assessing real-world impact. So when it comes to portfolio themselves, across these approaches, ESG is then utilized in two different ways. The first one is really a supporting role, and then the other one is really a leading role, which takes the ESG decision or the integration of the ESG factors to another level, which includes as well a more impact-focused approaches. So we did implement that framework as well because we believe it is a very solid approach to our research framework. And in place in order for us to meet as well the increasing regulatory requirements. And what you can see here is the cumulative number of policy developments related to ESG regulations. So that's whether investor or corporate related, which have really picked up significantly since the 2000s, resulting in more than 750 interventions globally in 2022. So ESG regulation is not only on the rise in Europe, but we can see it as well in other regions of the world. I'll just take, for example, in Asia-Pac, in particular disclosure standards in Singapore and Hong Kong, in the US, especially around new SEC climate disclosure guidelines. However, I think it is very important to note that Europe has been leading the way through the EU Action Plan, which will be taking a deeper look and sharing with you some of our observations on what has been done by the market to date. So just to maybe take a step back as a background, the EU Sustainable Finance Action Plan has been introduced in early 2018 with the main objectives of reorienting capital flows into sustainable investments, managing financial risks stemming from pressing topics such as climate change, resource depletion, and social issues, but as well as fostering transparency and long-termness in financial and economic activities. And then the outcome of the EU Sustainable Finance Action Plan is 10 specific actions that should help meet these goals. Well, the most relevant ones are the EU taxonomy, but as well as the Sustainable Finance Disclosure Regulation, most commonly known as SFDR. The EU taxonomy is a classification system establishing a list of environmentally sustainable economic activities. It could play an important role as well in helping the EU scale up the sustainable investment and really implement the European Green Deal. The EU taxonomy would provide companies, investors, and policymakers with appropriate definition of which economic activity can be considered as environmentally sustainable. In this way as well, it would create security for investors and protect them from greenwashing, help companies to become more climate friendly, and mitigate market fragmentation and help shift investments where they're most needed, hopefully. So if we think about it, the EU taxonomy is really a tool to help investors, companies, issuers, project promoters navigate the transition to a low-carbon, resilient, and resource-efficient economy. The EU taxonomy is really one of the cornerstones of the EU Sustainable Finance Action Plan. In this context, it really aims to provide a common language and a clear definition of what sustainable means in the context of corporate business activities. So the second pillar is the Sustainable Finance Disclosure Regulation, SFDR, which is pretty much encouraging greater transparency from financial market participants and financial advisors when it comes to their sustainability-related policies and objectives. So it really aims to improve the disclosure on how a product integrates environmental, social, and governance consideration into the decision-making process of institutional investors and asset managers. So if we dive deeper into SFDR, the regulation mainly evolves around two types of disclosure. The first one is the entity-level disclosure, and then the second one is the product-level disclosure. So entity-level disclosure is really a narrative-based disclosure. It's really around how we integrate sustainability. If we look at any of the principal adverse impacts, what we commonly call the PAIs, and how do we integrate them, but as well as engagement and voting policies, remuneration policy consistency, but as well as when it comes to the PAIs indicators themselves, really being able to report annually on the PAIs from the 30th of June 2023, which is the next major milestone. And these should be calculated at the firm level. And then the second pillar is the product level disclosure. So we will have for all products, they would need to disclose some level of information about ESG, how sustainability risk is integrated, whether and how PAIs are considered. And then for additional disclosures for Article 8 and 9 products, we will have more details required when it comes to ESG information, such as the percentage of sustainable investment, the taxonomy alignment, for example, and how characteristics or objectives, depending if the product is Article 8 or 9, are attained and how they're measured. That is something that we're going to go into a little bit more details for Article 8 and 9 and the different classifications. So under SFDR, all European funds are being classified by their managers into one of these three categories, so Article 6, 8, and 9. The naming derives from the regulatory text. However, we hear a lot of light green for Article 8 and then dark green for Article 9 funds. So the requirement for all of the products is really to disclose on ESG as per Article 8. What Article 6, what Article 8 and 9 funds will be required to provide more detailed ESG information to investors, with Article 9 really focusing on EU taxonomy related disclosure. So we would need to disclose the taxonomy alignment for these products. As of the end of April, Morningstar has collected SFDR data on over 150,000 investments in Europe, which basically represents around 90% of the funds that are open for or available for sales in Europe. And this can be as a very first analysis, but really the conclusions were quite interesting for us. Of all the funds reviewed, more than 25% and 3% are classified as Article 8 and 9, respectively, representing a combined assets of more than 2.5 trillion euros, and about 40% if we look at assets as a basis. This universe includes money market funds, funds to funds, but as well as feeder funds. And then based on this analysis, what we did is really trying to extrapolate that data and make an estimation. And then so far that we came to the conclusion that the European ESG and sustainable fund markets, based on Article 8 and 9 definition, could be worth as much as 4 trillion euros. So twice as large as our universe of sustainable funds as identified by our analysts. And the reason behind it is we really expect the number to increase in the coming month as managers enhance their strategies, reclassify funds, and launch new ones that meet the Article 8 and 9 requirements. What we are also observing is that Article 8 and 9 funds receive a growing share of total fund inflows in Europe. So while broadly speaking, the fund flows have declined from Q2 to Q4, inflows into Article 8 and 9 have remained steady, which has increased their shares as well in terms of the total inflows. So dive in a little bit again deeper into how asset managers that classify their investment as being Article 8 and 9 funds. Here are a few examples and how they have gone about it. So for Article 8 funds, we saw that often values-based exclusions were applied together with material ESG consideration, engagement efforts, best in class, but as well as thematic strategies. And then for Article 9, we're taking it to another level of details in terms of the portfolio level ESG KPIs that are measured and benchmarked from top to bottom, best in class thematics, but as well as impact strategies and the EU taxonomy alignment. What we have also observed are that asset managers are facing a few key challenges with regards to the implementation of the regulations. And one of them being the lack of data. There's currently a big lack of reported data simply because investors are being mandated to disclose on the regulation before corporate disclosures has been adopted. The second is that the regulation in particular when it comes to Article 8 includes a few subjective concepts around environmental and social characteristics, which opens the door as well for difference in interpretation into those characteristics. And as everybody is probably aware, the Level 2 regulation has been delayed several times, with the deadline now being shifted towards January 2023. To date, only the two first taxonomy objectives, so the climate change mitigation and climate change adaptation, have been finalized, with the others being drafted or being signed off by the Commission. And then in addition, it is really unclear how advisors are supposed to understand clients' preferences and present portfolio alignment. So more guidance on this side will be needed, which ultimately will lead or could lead to a challenge effectively communicating between advisors and the investors. So maybe just to finish things off, across Morningstar Sustainalytics, we have strong solutions in place to support investors across the value chain with different solutions that, well, at least help tackle some of these challenges, hopefully. The first on the company level data through PAIs and our EU taxonomy solution. And then on the fund level, through the SFDR attributes, the calculation services to support product and entity level reporting, the EET collected data, or what is known as the European ESG template, and then benchmarking as well. As you all know, Morningstar offers a variety of benchmark families, and then we have launched various ESG benchmarks. And then I went a little bit too fast. And then last but not least, portfolio reports across PAI and taxonomy to help our clients report to the regulator. And with that, we can open up for questions.
What's your rate card depending on? So from a pricing perspective, what's the basis for calculation? Number of funds or?
That's a very good question. So we do have a very modular approach in terms of our pricing strategy. Really, it depends on the different models that our clients subscribe to. But as well as we would like really to understand your investment universe. So in terms of your strategies, whether you're globally focused, whether you're European, large cap, small cap, in terms of AUM as well, and in terms of the data delivery as well. So we do offer, and that is something that has been part of our pricing strategy, is to allow our clients to access the data in which way they want, whether through our online platform, which is the global access, through data feed, FTP or APIs, but as well as some third-party platforms such as FactSet, Bloomberg, but as well as our parent company, Morningstar. So it really depends. It's a combination of metrics. And the idea behind it is really to customize our offering to the client needs and ecosystem. I know there has been a lot of information out there, so
but what about all the metals and mining investments that need to be made before the gigafactories? Do you think that's something worth large?
So that's a very good question. What we do, our approach in terms of looking at the company is really from a value chain, really looking at the production, anything that's coming from the services, the distribution, but as well as from an ownership perspective. So if a company has a majority stakes in another company, then that will be taken into consideration, for example, product involvement. So we really look at it from the ecosystem. We don't necessarily look at it from a supply chain unless if it's related to events, for example. So that is something that we monitor. So we do have a real-time monitoring of news, where we scroll about 60,000 news daily to be able as well to detect any controversies or any events that would affect the company as part of their supply chain activities as well. Yes?
In your supply or value chain analysis, what is the share of analysis that is qualitative versus quantitative? So in other words, to what extent do you look at Scope 3 level data being published by companies or from other sources relative to qualitative assessment?
So I'd say it's the breakdown is really into different levels. First, what we look at when it comes to, for example, ESG risk rating is really the reported data. So we would look at the annual reports, any official publication of the company, and this is our main source for ESG risk information. For anything that has to do with information that companies do not disclose, I'll say, for example, for carbon, especially Scope 1, 2, and most importantly, Scope 3, which there's not information around this, we do use our in-house estimation model to be able to translate or give an estimation of what would be the Scope 3 emissions, for example. And then on top of this, for everything that has to do with controversies or news, we do supplement our reported, collected data by anything that is happening in the news. But really the major focus for us is really reported data, because we would like to offer transparency to our clients in terms of retracing where is the data coming from, but as well as making sure that we have consistency in the way that we compare companies and the way that our clients could as well benchmark companies within their portfolios. We are a multi-asset class, so we cover all of the major global indices through equities, fixed income, but as well as private companies.
Are you working on a standard European certification? The European standard for ESG?
So we are working, and we have actually launched the European ESG template. That is something that we do have, and our clients have different ways to access that service, whether through our online platform, so they will have ownership on this, but as well as through managed services, through our Morningstar reporting capabilities, where we can either report on their behalf, or we could provide the data for them to fill in the EET templates. So that is something I believe that we have launched the last couple of weeks. And then just in terms of the solutions that I highlighted here for EU Action Plan and SFDR PAI. So for the SFDR PAI, we do cover all of the mandatory fields. So for the corporate, the sovereign, but as well as the optional ones, so the voluntary ones. We're aiming to have coverage for about 90% of them by H2 of this year. And then for EU taxonomy, we cover the two objectives that have been disclosed so far by the regulator, which are the climate change mitigation and adaptation.
Sorry, coverage means eligibility or alignment?
Both of them. So what we do is really look at the eligibility. So we have mapped what we'll look at it is really we'll look at a company from an activity perspective. So we look at a company really as a portfolio, if you would say, of activities. And then we have mapped this to the EU taxonomy. And then the next level is really looking at each of these activities that are already aligned, eligible, to what level are they aligned with the EU taxonomy. So really looking at the do not significant harm criteria and then the minimum safeguard to be able to say what percentage of that specific activity of this company that is first eligible is aligned as well with the EU taxonomy. So we do have coverage for about 10,500 companies. It is based actually on our largest universe, the Rating Plus universe, which covers 13,000 companies. The reason why there's a difference is really from financial institutions. That information is not already available. And since, as I mentioned earlier, we really have a big focus on reported data and as disclosed data, that is something that we have excluded until financial institutions have disclosed the data in their annual reports. Great. Well, if there are no other questions, we'll be around. And then we have a booth upstairs, I guess. Yeah, we're downstairs. So upstairs, so please feel free to stop by. We would be happy to answer any of your questions.
Yeah, so thank you very much for attending. Thank you very much for the speech.